Hello everyone, Clifford Bennett, Chief Economist at ACY Securities, and it's an exciting start to the week. I've got to tell you that US equities really do look to be under some pressure as we start the week. There is, of course, hope of the debt ceiling issue being resolved this week, an important meeting taking place on Tuesday on the Hill. Perhaps we'll see a full sort of pan out of that meeting by the end of this week. And of course, if the debt ceiling were resolved, that would be a bit of a boost for the US dollar and for equities and for bond prices. The only problem there is that problem moved aside, the United States still has several other issues, not least of which is stubbornly high inflation. We did see the headlines tick down 0.1%, but core is accelerating. And on Friday in the United States, that University of Michigan Consumer Sentiment Survey, which is probably the most accurate in the land on consumer state of mind, if you like, actually plummeted yet again. So I thought there'd be some sort of bounce because it's already at historically absurdly low levels. So you have to take into a context. And this is something a lot of people aren't speaking about. And that is they're saying, oh, it's fallen again. It's the lowest since, several months ago. But no, it's much bigger than that. US consumer confidence has only been this low twice before. The GFC and around the 1980 mark in that economic financial crisis, and we saw the US go into a deep recession shortly thereafter. And at the moment, we're looking at numbers that are the same as back in that early 1980s period. And in fact, consumer confidence at the moment is twice as bad as it was during the COVID lockdowns. So just imagine how depressed the US consumer was during the COVID lockdown period and economic upheaval going on in the United States. Well, they're twice as sad, depressed now as they were then. These are catastrophic consumer sentiment levels, and I've been pointing these out for the last 2 years. They've been saying again and again and again, the US economy is not out of jail. The US economy is in trouble. We've seen momentary spurt of growth towards the end of last year, dying away quickly in the first quarter of this year as GDP dropped sharply from 2.6 to 1.1%. And the outlook here with this consumer sentiment survey rolling over again at these very low levels is extremely worrisome for corporate earnings moving forward, because Wall Street depends on Main Street more than Main Street depends on Wall Street. And at the moment, Main Street USA is in trouble. The US dollar is strengthening. And I think probably that could continue for the moment. I do think the US dollar will be 15 to 20% lower over the next 2, 3, 4 years. Most certainly, well, nothing's certain in markets, but I do strongly hold that view. Whereas for the moment, the euro's had a 20% rally until its recent highs from the lows or the US dollar high of last year, and perhaps that was enough repricing of the US dollar lower for the time being, while at the same time the woes of Europe are not fully resolved either. And so I think this rollover in the euro and its effect on the Australian dollar and other markets will continue. So there will be some downside there. Some big news in Australia today is Newmont buying Newcrest Mining for around $19 billion. That will be supportive of the Australian dollar at the first light, if you like, and it will be supportive of Australian equities at first brush.